Hello, I am Vincent Abandula. I will discuss credit policy and credit term. So first is what is credit policy or accounts receivable? So a credit policy outlines the terms under which a company extends credit to clients and manages debt collection. It applies whenever a business invoices a client and begins work before receiving payment, effectively providing credit even if there isn't a formal policy in place. So, credit policy consists of four variables. We got credit period, discounts, credit standards, and collection policy. So, when we say credit period, is the time given to buyers to pay for their purchases, such as 30 days. Longer credit periods can boost sales but increase the risk of default and tie up more capital in receivables. So, when we say discounts, these are price reductions for early payments, like a 2% discount if paid within 10 days. While discounts can accelerate payments and stimulate sales, they may reduce revenue unless sales volume compensates the lower prices. Next is credit standards. When we say credit standards, these refer to the financial criteria customers must meet, such as debt ratio and payment history. Stricter standards reduce bad debt but may also limit sales, requiring a balanced approach. Now, lastly is collection policy. This involves strategies for collecting overdue accounts, ranging from gentle reminders to collection agencies. The policy needs to be firm enough to ensure that payments, but not so harsh that it drives customers away. Next is credit terms. When we say credit terms, it's the payment conditions set by the seller, dealing the time allowed for payment and any discounts for early payment. Now, firms usually state that credit terms specifying the credit period and account policy. For example, 2 over 10 net 30. That means 2% discount is available if payment is made within 10 days, with full amount due in 30 days. If the discount is not used, and credit standards and collection policies are more subjective and typically not included in the published terms. Next is credit policy. Next is credit policy. What's credit policy? It is crucial as it affects sales, receivables, and bad debts losses, with the executive committee responsible for setting it and credit managers for implementing or implementation. So a typical business credit report would include the following. First, we have the summary balance sheet and income statement. Next is a number of key ratios with trend information. Now, next is information obtained from the firm's suppliers telling whether it pays promptly or slowly, and whether it has recently failed to make any payment. Fourth is a verbal description of the physical condition of the firm's operations. The fifth is a verbal description of the backgrounds of the firm's owner, including any previous bankruptcy, lawsuits, divorce settlements problem, and others. Lastly, a summary rating ranging from A for the best credit risk down to F for those that are deemed likely to default. Now, next is credit scores. So when we say credit scores, these are the numerical rating from 0 to 10 that evaluates the risk of a customer defaulting on a payment. Where a higher score is 10 indicates a lower risk and a lower score of 1 signals a higher risk. These scores are generated through statistical analysis of various financial factors. Computerized system help streamline the credit valuation process by providing data-driven insights to support decision-making. However, despite these tools, credit decisions still requires human judgment to consider beyond what the numerical score reflects. Now, next is
About monitoring accounts receivable. So, the total accounts receivable in any type is influenced by credit sales volume and the average collection period. For example, Boston Lumber Company has a daily credit sales of 1,000 and a 10-day payment period. It needs 1,000 or $10,000 in receivables. If sales double to 2,000 per day, or the collection periods extend to 20 days, receivables would also increase, requiring additional capital. If management isn't vigilant, the collection period may lengthen due to customers taking longer period to pay or sales to weaker customers, leading to bad debts. So our formula is accounts receivable is equal to credit sales per day times length of collection period. So our credit sales per day is 1,000 times the 10-day collection period is total of $10,000. Therefore, it's crucial for the CFO to monitor receivables using techniques like day, day, day sales outstanding or DSO and aging schedule. So we're going to talk about day sales outstanding. So DSO is equal to receivables divided by annual sales divided by 365. So for example, suppose Supersets Inc., a television manufacturer, sells 200,000 televisions sets a year at a price of 198 each. All sales are on credit, with the terms of 2 over 10 net 30, which means if payment is made within 10 days, customer receive a 2% discount. Otherwise, the full amount is due within 30 days. Also, 70% of the customers take discounts and pay on day 10, while other 30% pay on day 30. Superset sales outstanding or DSO, also known as ACP or average collection period, is 16 days. So our formula is DSO is equal to 70% times 10 days plus 30% times 30 days. So that would be 16 days. And then we're gonna calculate the ADS. So units sold times sales price divided by 365 or annual sales divided by 365. So in our case, we have 200 sets of television times the price of 198. So that would be 39,600,000 divided by 365. So the total is 108,493. So our ADS is 108,493. Now, supersets accounts receivable, assuming a constant rate of sales throughout the year, will be at all times 1.7 million. So we have a formula for that. That would be receivable times ADS times DSO. Okay. So 108,493 times our DSO, which is 16, that would be 1,735,888. Now, day sales outstanding measures how long it takes for customers to pay for their credit purchases and can be compared to industry averages. For example, if the industry DSO is 25 days and Supersets is 16 days, it may indicate that a strong customer base or an effective credit department. Conversely, a DSO of 35 days suggests that customers may are taking longer time to pay than the company's credit terms allow. To gain further insights, businesses can use an aging schedule, which identifies payment patterns among customers. This tool helps companies pinpoint slow-paying customers and manages receivable more effectively, ultimately improving cash flow and credit management. So first, what is aging schedule? So an aging schedule categorizes receivable by age of accounts. For example, Supersets and Wonder Vision both have same total receivables on credit terms, but Supersets shows that all customers are paying on time, 70% by day 10 and 30% by day 30. In contrast, Wonder Vision has only 27% of customers pay its receivable over 30 days past due, indicating many customers aren't adhering to payment terms. Now, aging schedules must be created from a firm's account receiving ledger. as they cannot be derived from financial statement. Companies with computerized records can easily sort invoices by age to generate these schedules. Management should regularly monitor both DSO and aging schedules to identify trends and compare collection performance against credit terms and industry standards. If DSO increases or aging schedule shows a significant percentage of overdue accounts, it may signal emerging issues. So as you can see, this is a this is our table below. So this is the superset in the Wonder Vision. As you can see, 0 to 10 days or the discounted customer, 70% is for the supersets, and then for Wonder Vision only 47%. And then for 11 days to 30 days, payment on time, so supersets customer pay 520, pay 30%, so that would be a total of 100%, while Wonder Vision only has 26. So you have late payments 31 to 45 days to a 15%, and then 46 to 60 days, that would be 10 days, 10 days, 10%, and then 60 over 60 days, that would be very late or the bad debts is 2%. So that would be a total of 100%. So past dues, as Wonder Vision does, then the credit policy may need to be tightened or trade credit. So accounts payable refers to a money a company owes to its suppliers or creditors for goods or services received but not yet paid for. It represents a short-term liability on the balance sheet and indicates a company's obligation to settle these debts, usually within a specified time frame. Trade credit can either be free or costly. If the seller does not offer discounts, then it is free in the sense that there is no cost for using this credit. However, if discounts are available, a complication arises to illustrate to illustrate suppose so to illustrate suppose PCC Inc. buys 20 microchips each day with a list price of 100 per chip on terms of 2 over 10 net 30. Under these terms, the true price of chips is $0.98 because that would be 2% discount. Because of the chips can be produced only purchased only for $98 by paying within 10 days. Thus, the 100 list price has two components. So this list price is equal to $98 which is the true price plus the $2 finance charge. So if PCC decides to take discount, it will pay at the end of day 10 and show the 19,600 of accounts payable. So that would be with discount, that would be 10 days times 20 chips times $98 per chip, that would be 19,600. Now, if it decides to delay payment until the 30th day, then its trade credit will be 58,800. So that would be 30 days times 20 chips times 98 per chips, that would be 58,800. By not taking discounts, PCC can gain additional 39,200 in credit, but it comes at a cost since they forfeit those discounts. PCC needs to consider whether it can obtain this amount more cheaply than other sources like bank. Now, if PCC can borrow from its banks or some other sources for less than 37.24%, it should take the discounts and use only 19,600 of trade credit. So where did we get this 37.24%? So our formula is nominal annual cost of trade credit is equal to discount percent over 100 minus discount percent times 365 over days credit is outstanding minus discount period. So in our case, that would be 2, the discount, $2 divided by 98 times 365 days over 20 days. So that will be 2.04% times 18.25, and we will get 37.24%. Now we have two types of trade credit. So first is free trade credit. When you say free trade credit, it is a trade credit that obtained without a cost, and it consists of all trade credit that is available without giving up discounts. In PCC's case, where it buys on terms 10 of 2 over 10 net 30, the first 10 days of purchase, or 19,600, are free. Costly trade credit, on the other hand, is any trade credit over and above the free trade credit. For PCC, the additional 20 days, or 39,200, are not free because getting them means giving up the discount. So, the cost of trade credit can be lowered by delaying payment. If PCC extends its payment period from 30 to 60 days, the effective credit period increases to 50 days, reducing the frequency of lost discount to about 7.3 times a year. This lowers the nominal cost from 37.2% to approximately 14.9%. In times of excess capacity, companies may stretch accounts payable by paying late, but this practice can lead to issues associated with being labeled as payers. So that would be the end of my report. Hope you learned something about trade policies and trade credit. Thank you.